It's the ultimate investor's mantra. Buy low, sell high. But in a market that's rattled by constant fluctuations in the oil market, stubborn inflation, and shifting interest rates, is the dip really an opportunity or a trap? I'm Andrea Heng, and this is the Money Talks podcast. Welcome back. For retail investors, the urge to jump in while it's cheap is strong. The temptation is there. But how do you know if you're buying a discount or catching a falling knife? We're going to get some help navigating these choppy waters from Thomas Ng. He's a principal investment specialist at PhillipCapital. Welcome to the podcast, Thomas.
Thank you.
All right, so it's become almost an automatic reflex, right, for some investors to buy the dip, especially in recent years.
That's right.
Do you think we've become too trigger happy whenever we see a red day in the charts?
Well, to a certain extent, I will agree with that. Over the past decade, after the great financial crisis, there's so much liquidity. And because of the Fed put, right, generally speaking, most investors sees that the Fed is always there to help. And they would pounce on every opportunity to buy at the dip. So this is one scenario. Now, if you look back in the last probably a year since the tariff panic of 2025, now if you take a look at S&P 500, the pullbacks since April until January this year has been very shallow. How shallow is that? A 1 to 2% drop, probably in 3 to 4 days, and before the market starts to bounce back again. So I can understand. It has become, the mantra for many investors, retail investors, to see that once the thing comes down, I should go and buy because, either Trump's going to tackle or maybe the Fed is going to come in and say something really positive to support the market.
Yeah.
So
you,
yes,
you said something earlier. You said Fed put. For the benefit of listeners who have no idea what a Fed put is, can you explain what it is?
Oh, the idea behind is that every time if the economy goes into recession or with very weak employment numbers, which this is the two major mandates, right? The Federal Reserve or the Central Bank of the U.S. wants to look at, right? So every time when these two things happen, they will do something called cutting interest rates, right?
Right.
And when that happens, generally it supports the market.
Got it.
So this is the concept of the Fed put.
So when investors buy the dip, and like you said, so many people are sort of buying into this mantra, right? What are the common mistakes that investors tend to make when they are buying the dip? I mean, what do they not see?
Okay, but before we get into that, maybe I could say that from my point of view, as a stockbroker and advisor for the last 22 years, it is better to buy on the dip rather than to FOMO and buy at the top.
Right, okay.
So it is okay in a sense, right? I mean, if you buy...
It's not a bad thing.
It's not a bad thing.
Yeah.
Like if now the market's at all-time high and people are chasing in, and for all you know, Trump comes in and says something really crazy again and the market starts to dip to another low. Now, these guys have to probably cut a position or sit on the loss, right? But if you buy on the dip, right, and then now you have a bounce, you can do two things. You can sit on the gains or you can take profit, right?
Right.
Right.
But what are some errors that they may commit when they're buying the dip?
Okay, the problem is you're not sure whether the current situation, is it just a one-time event that's happening in the market now, or is some, may I use a more technical word, where the market is overbought and then because of this overbought condition,
right,
the market exhausts all the possible buyers in the market at any given point in time.
Okay.
Right. So when it's very overbought, for example, just 1 month before the war starts, right, at that high point in the S&P 500, probably all the buyers that wanted to buy has already come in and buy.
So there are barely any buying positions left.
That is correct. Now, what happens is that when there's some negative news or a trigger point that comes into the market and the market starts to come down, there is a lack of buyers to support the market. Right. So this is a technical situation, a sentiment situation. Now, if this is the situation, then it's okay to buy on the dip. But the problem comes when there are changes to the economic conditions, especially in terms of interest rates, this currency movements, the growth outlook or earnings per share outlook.
Of companies.
Usually,
yeah.
if a combination of these factors comes in, then it's not so straightforward that we have to buy the dip. There could be changes to the global parameters or the parameters that's affecting the global economy. Now, for that, we have to take a second look. And buying the dip then, or at this point, will be very tricky.
Right.
Will be a little bit risky, actually.
I would also add that I think one of the unpredictabilities when buying the dip is not knowing how prolonged the dip will be. How much further can it drop? Because you never really know if the dip that you're buying is indeed the bottom, right? I mean, what do you say to that?
Okay. That's the point where the stockbrokers or may I use the word seasoned stockbrokers or seasoned advisors come in to help.
Okay.
Now, the reason is there are parameters or tools that we can use, perhaps using fundamentals or technicals to ascertain whether a certain point, may I use a support point in the S&P 500 levels, right? Or a valuation price point where we think that the risk is low enough for me to dip my toes into it.
Okay.
Right. We need to use these tools. But most retail investors may not have that. Well, I guess they have access to the tools, but they may not know how to interpret or use it, to the most effective way, you see. And that's where we come in, I guess.
Okay,
right?
So studying the patterns and all that,
Indeed.
that's something that you guys do daily, essentially, right?
That's right.
Okay, so before someone hits the buy button on a falling stock, for example, right? What is the one most important thing they must do? The single most important thing.
I think the most important thing is that this particular investor or retail investor, he should do his homework first to see that whether this stock that he loved, 1 month ago before the dip happens, right? Does he still love it? Does he still love it now?
Really?
Because that means whether the fundamentals, is it still in place, right? If you like AI stock or you like energy stock, what have you. So if the price comes down, is the reasons that you like in the first place, is it still there?
Right.
If it's still there, then we can move on to the second step, right? Is this deep? Is it the correct level, or is it the correct valuation point where I should buy more?
When you say determine how much I still love the company or not, right? Whether it's the stock has dipped or not. But as a newbie investor, what does that mean? Am I supposed to read up on the company? Do I look at the company's P&L statements, latest earnings or past earnings to watch its trajectory? What do I need to do in order to decide whether or not I love this stock through thick and thin?
Right. So I think the main idea is that when you look at the stock, the company, you want to know whether there is that growth angle on the earnings per share. And fair enough, I think probably you may need to look at the business, the type of, whether money, are they generating that type of money, the type of growth. And if it does, right? So I think this is the main thing, whether there's a growth angle on the stock. If there is, then it makes sense to buy. But because the stock price moves up as the earnings gets better, right? It has to be that case.
So how do I determine growth when I look at a company's profile, for example? If I go onto a website and I take a look at this company's particular stock page.
Okay, so many of the freely available information on the web, they do show some of the fundamental analysis, some of the parameters or valuation metrics, and you can take a look from there. But again, newbie investors may not really fully understand, or they can decipher, right, or can analyze it. So that's where the research analyst comes in, right? The research analyst will do the number crunching for you. You get the idea behind it, whether that growth figure, is it going to come in? And it helps that the investor, because it's a journey, investing is a journey. So it is good that every quarter or every half a year when a company reports its earnings, it's good to dwell a little bit into what the CEO is saying. Right? I mean, what is the outlook for the next half year or next quarter? Right? That will give you some insights whether that love should remain or not.
So how then can we distinguish between a short-term pullback and a more meaningful long-term reset and market expectations? Because we know something called a market correction, and that is quite a significant event in which people feel that's the time to buy a dip. That's one scenario, for example, right?
Sure.
So how would an average person, an average retail investor decide or ascertain, okay, this is short term, I'll dip in now, or okay, I'll wait it out a bit more because there are signs that it's a more meaningful, long-term, long drawn-out reset in the market?
We need to know roughly where the market has come from. And the way to look at it is to look back the price action, for example, the S&P 500 or a certain stock, and see how long has this index or the stock has been trending upwards. And if I were to keep it simple, let's say we look at the S&P 500 index itself, right? In a year, usually you can see easily probably 1 to 2, 5% to 10% pullback.
So
there is normal actually.
So 5 to 6%, that's
5 to 10,
5
maybe?
to 10%. That is the definition of a dip, if that in that
In
sense.
a way, yes.
Okay.
Yeah.
And a year is a decent timeline to look at.
That is correct to a certain extent. Now the problem is that over the past year, or rather, it's not a problem, but something that I did share with many of my clients, which is post the Trump tariff panic, of April 2025. What happens is I was just sharing earlier that the pullbacks has been very shallow.
Yeah.
So in a way, a pullback of 5 to 10% actually is going to be normal. From April last year to, let's say, December of 2025, there has been we didn't see any heavy corrections or pullback.
Got it.
Right. So there is expectation that this one that is between 5 to 10% correction is going to come very soon.
Right? It's a very akan datang thing.
Yeah, it's coming, so we have to wait for it. And if it comes, you don't have to panic.
Right.
It's
but how
part
do
of
we
the whole
know?
process.
You say it's coming, but how do we know it has arrived? What's the surest first sign?
That's the problem, right? We can't, and only when it
I know
happens.
it's crystal balling, but
yeah. So we can't. Oh, but there is. Then again, there are tools that tells you, the thing seems to be shaping up to a heavier correction, and you have to be careful, or you can get ready. You've done your homework, you can get ready for that dip.
Okay.
That akan datang, right? And it's really coming.
Yeah.
So the point is that you're totally prepared for this dip, and you're not shocked by it.
Interesting. So right now, clearly not the time yet because stocks have rebounded a little bit. But
that's right.
As of this conversation, as of this recording at least, we don't know yet when that market correction is going to be, because you're saying, and I'm just recapping here, that every dip we've seen thus far from April 2025 has been shallow. It hasn't been a meaningful reset enough to be called a market correction. Okay, so where do you see retail investors most at risk of moving too quickly in today's environment?
Okay, so I think it comes back to the part where if they didn't do their homework, or they're coming in for a so-called a quick buck.
Yep.
And no homework done, just want to come for a quick buck, and then that
FOMO even.
Yeah, or that I got to come. It's a dip, right?
Yeah.
And I have to just buy something.
Exactly.
And that's where the problem is. And they didn't perhaps do a counter check with their advisor or their broker and say what's exactly going on. And there's so many nuances, right? For example, when this thing happens, I did tell many of my clients that it's a kind of new situation because the oil shock, we have not seen it for quite a while, right? So maybe we might need to just wait out and see more information coming out. And then what happens was that over that 1 month when this oil crisis starts, right, so much news comes in, right?
Yeah.
One is from Trump and then one's from Iranian side. I told many of my clients, calm down, let's reassess the situation. You don't really have to follow the everyday, the headline news. Perhaps you just need to look at the oil price, because the price is the ultimate may I use the word arbiter, right? Which means it tells you where exactly is the situation.
Right.
Sometimes the news come too much, come too fast, and you're not getting it, and you're worrying over this and that. Why not just look at the price?
Okay.
Yeah.
So what do you look out for in the price then in this example?
So during the time, I think prior to the eruption of the war, right, oil was probably below $70. So I told my clients, if it doesn't climb above 80, I think this is probably a weekend thing, After that, life goes on again. So we have different parameters, and then when it gets above 80, I'm telling them between 80 to 100 and stuff like that. And if it's above 120, I think this is big trouble.
I
and
see.
stuff like that. So it's easier to assess rather than sticking yourself to every piece of news that's coming out.
That's true,
Yeah.
right?
So,
It's just to sort of filter from the noise. Just look at the
Indeed.
fundamental, the one strong indicator
indeed,
of
indeed.
where the market stands. So, in this current state of the market, right, where there's so much uncertainty, are there specific sectors where buying the dip is particularly dangerous?
There are some sectors, if you look at the S&P 13 sectors, right, I think one of them there is sort of in some sort of trouble now is the software sector.
Okay.
This segment of the market, in the US market, actually dropped before the Iranian war starts, right? So, of course, the Iranian war came about. It forces another leg down on the prices of these companies, the software sector.
In general, there is market uncertainty, there is market volatility, with or without wars, with or without geopolitics. Classically speaking, which are there other sectors that we need to be more wary of when, where buying the dip might be a bit trickier than others, not as straightforward?
Maybe the other one I can talk about is the gold market and the crude market. Well, the gold market, everybody was saying that because of this volatility going on, this global geopolitical situation, gold was shy. The problem is, if you look at the charts and you align to the dates, the day the war erupted was the day the gold price started to drop from the high.
Yeah, which was very unusual.
Yeah, and clients would come in and buy on the dips, saw a further dip, right? And you were like, oh, okay, what's happening now? That's where the nuisance come in. The problem is because the US dollar has been gaining strength. If the dollar is strong, gold prices will be affected to a certain extent.
Yes.
The intermarket relationship sometimes hold, but sometimes it gets broken.
So for someone who's looking to take advantage of lower prices, but is afraid of the volatility, and I think it's safe to say that's many of us, Thomas, does averaging in still hold up as the best approach to investing, or is there a danger in averaging down on a losing position?
Okay, to this question, I think the overarching answer to that will be, is that major trend, the major uptrend, is it still intact? Right? The concept of uptrend in the two-dimensional chart is just basically one line pointing upwards.
Yeah.
If this major trend line is not broken, then it is correct to say every dip, it is a reset in the prices. It's a time to buy, as long as the trend is your friend, right? The trend doesn't break, and then the trend is your friend, so it's okay to go ahead.
Okay.
But if it gets broken, and there are probably certain reasons out there why it gets broken, and then we have to reassess the situation. So the quick answer to the question is yes, it makes sense if the big picture, fundamentally, technically, is still intact, then yes, buying on the dip is the correct way.
Right. So you really need to look at the journey of that stock price.
That is correct, yeah.
Where it has been before it came up and has come down a bit, and then it climbs up again. You really need to see that picture.
That's right, and that the trend is still intact. Right.
So I want to paint a scenario for you now, and something that we try and do on the Money Talks podcast.
Sure.
Say I'm prepared to invest $10,000, and say I've averaged in because I'm not sure if I'm seeing the bottom yet. We talked about this earlier, right? What's a good approach? 5K in 2 months, 1K each week, or something like that? What would your advice be?
Okay, I see. Perhaps we can use the word phasing strategy. You phase out, and then you split out the amount that you want to go in. So probably we can divide it by 3 or a third.
Okay.
Right, and a third sounds correct because what we want to see as professionals, we want to see when price hit a low point, are the sentiment indicators or probably some of the technical indicators, are we supporting this? Which means, are we exhausting the sellers already?
Yeah.
Right? Okay, so if we confirm that, then we take a look at the fundamentals, which is what the homework was about, right?
Yeah.
Do you like a stock when you're trading at PE 20 times and now it's 15 times?
Yeah.
You still love the stock, then 15 you should buy more, right?
Yeah.
So we put in this and we go in and if we tick all the boxes, we take that first phase, right? The first tranche goes in.
Yep.
that 3,000 goes in. And then we wait for a while. Well, as for answering whether it's going to be 2 weeks or 1 week, well, I think we can't use that time frame that, every 1 week I must try to do something, right? Because we don't know how long the war or some of the situation may persist. So what may be a better way to assess whether the second tranche is coming in or not is to see whether the price start to turn from there, right? If it start to turn from there, and then from the technical point of view, as a technical analyst, right? Well, we want to see, did it manage to break some resistance levels, right? If it does, or the other way to look at it from physics, does it gain enough energy to break past the stratosphere? If it can, then I'm going to put the second tranche
it's
in.
that turning point from when it goes from a straight-ish line to a steep line.
Yeah, not necessarily a steep line, but you managed to clear some levels that we think at this level there are probably a lot of sellers, but there are buyers. There's the buying pressure is strong enough to overcome this level where sellers all come out. And if it does, it means that there is this big money coming in that forces through.
It's a classic supply and demand picture.
Absolutely. So if it does, then we do it in the second tranche.
Got it.
Right,
Okay.
Right. Now, the other question is, if it didn't happen and it goes another leg down.
Right.
Right. And then we have to go back to the sentiment indicators to see whether, is it somewhere around there? Yeah.
So there's a lot of psychological pressure during a sell-off, right? People are often afraid of missing the bottom. Again, something that I mentioned earlier as a scenario, right? How would you advise someone to manage the emotional urge to do something when the market is dropping? I mean, you were kind of alluding to it earlier, and I wanted to expand on that, right? Because it is an urge. You're like, this is the kind of FOMO that is very hard to resist.
Yeah, with the urge, but not sure what to do, right?
Yeah.
Now, every time some of the clients will call me and say, so can we buy now? And then I
How many calls a day do you get when something like this happens, by the way?
Many calls. And every time I use this answer for them. I say that, hey, Mr. Tan, do you remember that, in the darkest days of COVID, when we're talking about people dying, sent to hospital, and we are, closing this whole area, the stock market was open every single day.
Yeah.
So what's the hurry? I mean, seriously, okay, you miss it. You were traveling, you're in a business meeting, and then what have you, right? You miss it completely, but it's okay. You know what I mean? Or if you miss that so-called low and then it spikes up and stuff like that, you're a little bit, you're kind of late, right? If you still want to go in, well, you just take a smaller tranche. Then
Which goes back to your question: if you like the stock in the first place for fundamental reasons, nothing should stop you.
Yeah,
right?
nothing, unless it goes back to your back to square one. Right? But otherwise, if you say low, I think you still can go in. If you're not confident, then you just take a smaller amount, right? Instead of the 3K, you put in 1.5, that kind of thing.
Okay,
yeah,
cool.
It's positioning, sizing.
Sizing. I think sizing was a new one for me. That's something for me to think about as well. So just to cap off our conversation, do you have any advice for investors who are completely new to the game on how they can capitalize on a dip without risking too much? If I'm a first timer, let's say I'm opening my brokerage account today. Tomorrow, Saturday, Sunday, weekend, I have time to sit down to think about it. The money's in the brokerage account and I see that there is a stock that I do like and there is a dip. What do I do?
My answer to the client will be, perhaps it could be of a lower risk if you were to buy ETF, index ETF, rather than the individual stock, right? Unless you really have done your research on the individual stock, you'll really like it. Or maybe if it's a mega cap, right? If it's one of the big cap stocks, okay, I think you can go ahead. But otherwise, maybe starting with the index, S&P 500, the Nasdaq or the SCI ETF could be a lower risk because of diversification it gives you, right? To dip your toes into the water rather than going straight for one single stock. Yeah. Anything happen to the CEO, the stock's going to drop, right? Yeah. So we're this problem.
Yeah.
So
I think that's really good advice. Actually, it's literally a basket that you can dip your toes into without worrying too much, because then you're spreading your risk a little bit more.
Right.
Thomas, this has been absolutely helpful. I'm enlightened today. Thank you so much for sitting in that seat today.
Thank you so much for having me.
And thank you, our Money Talks community, for always tuning in. I want to leave you with a question now. When you see the market dip, do you buy, do you hold, or do you look away? 3 different approaches. I want to know what you think. You can let us know in the comments section from wherever you are listening to us to, or you can email us directly as well at cnepodcasts@mediacorp.com.sg. This has been the Money Talks podcast. I'm Andrea Heng, signing off.